This is the kind of trading, the kind of markets that if you can follow a trend, it's going to make everybody feel like a rock star. So, one thing I always, try to remind people of is when this kind of thing happens, one, enjoy it, be nimble, move fast, but also don't forget that, don't just throw out whatever your normal trading system you have been doing is, because as the market volatility gets a little bit more back to normal, then, you want to be able to, switch gears to pull that different club out of your, bag to be able to use it, okay? You don't want to be stuck with, changing your system every time the market changes. You want to be able to adapt to it. But a lot of people, what they do is they change it and they forget what they had, okay? And so they don't have that system. It's sort of like, okay, now I'm going to, play golf and I'm going to use a driver, and then I'm going to get all the way down to the green, and I'm like, wow, this driver's not going to do me good. I'm going to use a putter. So I use a putter, but I forget what it's like to have the driver system, okay? And so when I go to that next hole on the course, I pull out my putter, and I wonder why it doesn't go very far when I hit it, when I'm supposed to be using a driver. So, just don't throw out what you did have, but just be willing to adapt and change and pull out the right club at the right time. When things do happen. And don't get overly confident. Some of y'all made, I know some of y'all hopefully didn't lose too much. If you were using, Nadex, or you were using defined stops and be disciplined. Some of y'all made an insane amount. Don't get so confident that you just amp up your size and think that, you're now, God's gift of trading. And I did pretty well. I'm hoping a lot of y'all did really well too. But don't get cocky on your size. Keep your risk management in check. Okay. We got, stocks. They flew up. They gave up most of their morning gains this morning after, Europe closed on out. The dollar, trims a lot of its gains off of the Fed statement after Dudley came in and said September, hike is less compelling. So, we do have some big things coming up. And obviously, September is that month that the Fed likes to jack with the market. If you just want to go back and look over it, and international developments have raised downside risk of, you can say whatever he wants to, okay? But they like to surprise everybody. So, in 1 September, they're like, everybody expected a, reduction in the rate. And then they held on to it, and then they waited till October to do it, So just understand that September is when they really like to mess with the market. What that means is you get volatility. Okay? But it also means is, if they're saying, hey, they're not going to lower it, well, maybe they won't, maybe they will. But these statements mean nothing but volatility, because it makes it harder and harder to get in there and, really pinpoint what it is. So when you see all these mixed statements coming in, Goldman saying, hey, it's September. And then Barclays is like, no, it's not going to happen. And then all of a sudden the one Fed's like, I think that it's a lot less compelling to do it now. So he didn't say I'm going to vote no. Of course, he's not allowed to. I don't know how much he's allowed to say. But, we have a lot going on. And let's see here. We also, gold fell on down there. Oil's turning down. There's a lot happening here. Oil, obviously impacting a lot of people here in Texas. We're loving, of course, the insane cheap gas. It was interesting. I was driving by a gas station yesterday out in the middle of nowhere, and it wasn't open anymore, and it had those $4 and $5 prices still up. So it went down right as oil was at its peak there, and now it's really low. Of course, it's impacting obviously a lot of people who are used to drilling for that gas, so they're having to get a lot more creative. And it's interesting. There's always two sides to those up and down moves. But what do you need to be aware of? What's coming up? What's in the news going on? I know it can be really confusing with all these things happening. And, what's important that you should be focusing on. And so I want to talk a little bit about that today with you. And, we'll look at, what else there is, on the list. And see what we can do. We had oil inventories came out last week. They were the highest levels they have been in over 80 years. So let's see, looking at the release today. And what they say, let's see, crude imports average 7.2 million barrels. What do we have there? An expectation of 1.0 was a forecast. We're actually a little bit lower than expected. Um, let's see, per day, 1% below the same 4-week period. Let's see, at 450 million U.S. crude oil trade, nearly was not seen this time of year in at least the last 80 years. So we still have that last 80-year thing going on. So that's obviously weighing on oil, meaning we have a massive surplus because we've turned so much of our oil right here inside home. And of course, we've made cars more efficient. Combine those things together, you get a lot of cheap oil. Let's see, going on over, I want to look at, I know there's a couple things I want to bring up on the news with you. So let me get that up over on my other screen as we go through it. And if you wonder how I got to that, I go to Forex Factory at 10:30 a.m. On Wednesdays, you'll see crude oil inventory. And then if you expand it, this little folder over here, you'll see latest release. You can click on that. It actually brings up the EIA.gov report. And then that third paragraph, second sentence right there is actually where I'm finding that 80-year report coming on out. So if you're just to, let you know sort of where I find that information. Let's see, going on into the end of the month here. I know one of the biggest things we have going on is the Jackson Hole Symposium. I want to say it's starting tomorrow. Yes, it is. Jackson Hole, this is... I think this has something to do. This is just maybe it's just me, but I think it has something to do with why they always jack with the markets in September at the Fed meetings. And so it's when all the bigwigs, the finance ministers, the central bankers, the heads of academia, and of course big hedge fund guys and everybody else, they get together and they talk. They don't let the press in. They come out and they talk to the press. So they have a little fun talking to the press. So get ready for that over the next couple of days. Who knows who, just like today, Dudley's sort of coming out and talking right before this, but there's going to be a lot of that where people just pop out and say something, and, who knows what that's going to cause. So just be aware. This is sort of a weird, it's sort of like a G20 summit, but bigger. Okay. And a lot of volatility can come out of just random statements. Okay. So let's see, what does this say here? We got Bloomberg releasing a story that China swoon sharpens Jackson Hole's focus on feeble inflation. So this is where they're gonna get into this. They're gonna dive into it. Timing is everything. Central bankers gather in Jackson Hole, Wyoming this week for an academic discussion on inflation, just as China's slowdown spooked global markets and renews fears of falling prices. The Kansas Federal Reserve host policy makes including economists from around the world on Friday and Saturday at an invitation-only annual retreat. And the mountains, the theme is inflation and monetary policy. And expectations are high that the highest-ranking Fed officials at the conference, Fisher, will shed light on the timing of the Fed rate increases. Let's see here. What did Yellen say? And Yellen has said she isn't attending this year's conference. Yeah, she's attending. She just may not be there. She has somebody. The backdrop, aside from the scenery, will be the puzzling case of wages, prices, U.S., why they haven't responded more to a near halving of the unemployment rate in less than 6 years, because it's a fake number. They just stop counting people. So should recent market turmoil subside, that may be the only thing holding the Fed back from a rate liftoff in September. So they're looking at inflation, and basically says, hey, if unemployment is not there, then what would hold them back? Not just China having an issue. So that's a probably a pretty good article to check on out right there on Bloomberg. China swoon sharpens Jackson Hole inflation. So inflation obviously is going to be front and center. It's a central banker concern. It's the Eurozone concern. It's Asian economy concern. And, because they've been printing like crazy. Everybody has. And then, the commodity prices have been dropping like crazy, so showing deflationary action. And then, jobless rate has dropped to 5.3%. So that's basically what the Fed has defined as full employment. Okay? Meaning we no longer count people, and now everybody's employed. So they need a justification, I guess would be a way to put it. They need some sort of economic justification. Now, they can make anything up and spit it out, but, they're basically there to help employment and inflation. That's their dual mandate. And so if we're not seeing severe inflation according to how they define inflation. They don't include, of course, many things, but I mean, you're seeing oil prices drop, right? You're seeing commodities drop in prices. You're seeing the markets even drop in prices. So we're not experiencing inflation, and employment looks solid. So the one thing they like is they do like what they call a 2% goal. Now that doesn't include your house, your food, or your energy. Pretty much what you spend your money on. So we'll talk about that a little bit more when we get back. This is, the sort of the big focus the next few weeks. The markets are going to have their eyes on. They're right there. All righty, folks. We're going back here to the diagnostic trading hour. Okay, so looking at a few things here real quick. We were talking about the Fed, and we were talking about Jackson Hole coming up and how they basically they need to justify each time their extension. And they're like, well, inflation fears. And, well, we have deflationary, not inflation. And, of course, that's part of their reason of keeping the interest rates low. So that would probably be their one way is, it's not inflating if everything's getting cheaper. So let's see, lowered expectations. The absence of Yellen and Draghi has lowered expectations for a major policy announcement at Jackson Hole. They're not going to make the policy announcement there. They're going to wait. Okay. So that will increase the scrutiny from any remarks from Fisher. He's scheduled to appear Saturday on a panel with the Bank of England Governor Mark Carney, ECB Vice President Victor, and Bank of India Governor Rajan. Depends upon where he places emphasis on any comments about inflation. So when is this conference? Okay, these are the little things I want you to start paying attention to. Saturday. So if you are wanting to hold a position into the weekend, okay, you don't know what's going to come out of that conference. And it could have a massive impact when the markets open back up. Okay? So really take that into account on your positions that you may be holding into the weekend if you're crazy enough to do so after the last few days. All right? Fisher said on August 10th in an interview he expected prices to move gradually upward while adding the temporary headwinds restraining inflation were still a concern for the Fed. You probably want to get a richer sense of the factors that give them confidence in inflation getting back to 2%, said J.P. Morgan. Feroli there. And then Chief U.S. economist at UBS Securities said he also expects Fisher to share his thoughts on recent market turmoil. He has to address this somehow. They can't let that undermine. He has to address it somehow. Perhaps says markets are just volatile and they can't let that undermine monetary policy, which I think is a very high probability. Okay. Everybody said they're going to raise it. Goldman started saying, hey, they're going to raise the policy in September. They said this, I want to say back in December. Okay. They've been saying it ever since. Now they're going to say, oh, they're not going to raise it. They're not going to raise it. Okay. And that's usually where the surprise hits. So anyways, if you want to play it, you actually can play it on Nadex. They do have economic event binaries. So it's not really the way I like to play my trades. I'm not big onto the economic event binaries. There's not enough liquidity. There's not enough, meaning the size is horrible. Bid offer is horrible. And you're basically just sitting there waiting on a, heads or tails. So not my favorite. There are some ways to play them, but I want to play more than one contract at a time. But it can be fun, nevertheless. Anyway, so we're looking at all this, and Jackson Hole's coming up tomorrow, Thursday and Friday. Anybody can come out at any time and say something on the press, okay? And then Saturday, there's going to be this big conference between all the, between India and Britain and the U.S. and the EU. Basically, most of them, the second in commands on a lot of these. And so you want to just be aware that that's coming. Like they're not. For them not to be at this conference is huge. For Yellen and Draghi not to be there, so they're probably having their own little meeting over on the side, trying to figure out what they're going to do instead of wasting time going to a conference. But I want you to be aware of that because that is the big event over the next few days, and that's where a lot of the headlines are going to be coming from. Okay, and it could cause markets to they're going up, and then boom. And then it stops, and then somebody comes out, and then boom, back up. So just be nimble, okay? Just like you have, I don't think the moves will be as big as they have been, but they'll still be there. So, um, okay, well, that catches us up on just sort of, I wanted you to have that. Often, what may happen, because once that's come out, that's a lot of the news. Okay, unless China decides, with this crash, that could change up the whole seasonality cycle. But usually, we'll get pretty quiet until for the next couple of weeks until the Fed meeting comes out. And usually drift up on Labor Day weekend. So we usually see the market drift up and go up on into Labor Day week there. So coming up next week. Let's see here. Yeah. So next weekend, not the 31st, obviously, but sort of weird how it falls this year. It's going to be on the 7th. That week is usually going to be a positive bullish week seasonally. And we'll see if that cycle continues. And then it gets a little bit more crazy around the middle of the month on the 15th. Drop it down most often. If they raise that rate, expect that drop. There. We'll be right back. Alrighty, folks, we'll come on back here to the Diagnostic Trading Hour. We're going through the news and just trying to, get you prepped and ready for, what's coming up. Holiday weekends coming up. People are going to be, they're going to, Jackson Hole thing is going to take off. And then people are going to be ready to take a vacation, go to the Hamptons and chill out. So we'll finally start getting some lighter liquidity. It'll be interesting, but what worked last week isn't going to work next week. Okay. So just be aware of that. I really want to put that caution out there for you. Some lessons I want you to learn is, about implied volatility whenever things like this happen. Okay. So whenever, you get, how do I put this? Whenever you get massive market movements, obviously implied or expected movement goes up. Options get more expensive. And just to visually chart that for you, let me get this off of a seasonality chart. I'll move the chart over here so you can see it in just a second. Let me change up the whole style of it. There we go. And here we are. Okay, so going in and let's pull this back. Okay, so now you can see sort of, this is just looking at a 15-minute chart of volatility. If we go back and look at daily, just so you can see how high it did get. Okay, massively high levels right there, up to 53.29 a few days ago. Okay, so if we go over here, we can see the highest level we've had in the past, year? If you go all the way back is maybe 30, and that was a pretty big peak. It's been averaging closer around to, 15 or so. And so, we got almost 4 times the amount of implied volatility or expected movement because the market was moving so fast. And it's still high. It's really high. Okay, it's still up here at like 35. If we go on back and let's look at weekly charts, and when you see, even for the last several years, it's really high, and it's still really high. Okay? What does that mean? All right, well, implied volatility is the expected movement. Vega is the measurement of how much an option price changes. Okay? How much does an option price change based on basically 1 point of change in implied volatility of that underlying market? So once you have that down, once you know how much it does change, then the next step is to go in and go, okay, well, how can I take advantage of it? What can I do? And, well, your out-of-the-money options are going to be a lot more expensive, okay? Again, your out-of-the-money options are going to be a lot more expensive if you're looking to, place these trades. And so what you want to do is you want to go in there and you want to look at, if they're more expensive, how can I take advantage of a more expensive contract? Okay, well, the best way to take advantage of a more expensive contract is to go in and do what? Is to go in and usually collect premium. Okay? That is most often going to be the way that you're going to want to take advantage of high premium because you want to collect it, or some people would call it selling premium. Okay? Meaning I want to be on the receiving end of premium when I do, this kind of trade. Okay? So again, I want to be on the receiving end of the premium when I do this kind of trade. And let me give you an example. I'm trying to pull a couple up. Okay, so if I go in and I'm doing an option, and let's say normally the cost to buy it out of the money option is 20 cents. Well, now it's, let's say, $1. Okay? Well, if I pay that $1, now if the market is really volatile, that $1 may be worth it, but it's really, it's just a lot more expensive. What cost 20 cents yesterday cost $1 today. And so if I go and I sell it for $1, and then it drops down, like when it's up here at 53, it drops down to 36. So I collect that premium. And a very, very popular way to trade options, of course, is to collect premium. It's one of my favorite ways. It's a little more challenging because I'm usually trying to collect it on time decay, not simply IV change, okay, implied volatility change, because time will also eat up that premium. And when markets are moving really fast, you don't necessarily have a whole lot of time to take advantage of it. So, that's one thing you just want to be really aware of is, you don't have the time on your factor when the implied volatility is as high as it is. Okay? And I'm trying to look at, copper because I want to see, I know they've had some high implied volatility lately. And see if maybe we can get an example there. Give me 1 second, I'll pull that up. Looks like Z5 over there. All right, and okay. Anyway, so I wanted to pull that up for you. And let's see. Yeah, that's just not quoting the way it should. Okay. Let's see if there's anything else. But yeah, it's just all this premium. And let's see. Let me look at USD CAD. I'm trying to see if I can find one that. I'm trying to find a good example. Something I want to show you. 0.335. Then where are we at? So let's see here, 3292. Trying to see if we can find any good premium trades on this. Nope, not there. I was looking for a specific one to try to see if I could pull it up. And I'll go for one other one real quick. And if not, I'll just do a reset. We'll rebuild. Okay. Yeah, I was looking for something right there. And it's not there. Okay, sorry about that. We'll just reset, and then we'll pull up. Let's just pull up US Tech. There's plenty of premium in it. Turn US dollar off. Put US Tech on. Let's zoom in a little bit. Okay. So right now the market is priced at 40.53. So this will be a good example. Okay, these are cards that should expire at 1 o'clock. So 40.53, and you can get a contract right now at 13 points higher for $14 to collect premium. That's insane. We used to never. Usually it's like you go like 1 or 2 strikes out of the money and it's like $15. So now you're going 1, 2, 3, 4, 5, 6. It strikes out the money and get that kind of premium on them. Why? Because the movement is higher, and the price of a binary contract. Here, let me turn off the price colors here. There we go. So the price movement on this is higher. The implied, the expected volatility movement is higher. And a binary's price is reflective of probability. Okay, so again, a binary's price is reflective of probability. And since it is reflective of probability, then expected move is higher, then you'll be able to get more. There's a higher probability it'll move that far. So you're able to collect more premium or receive more premium. On the same side, since that expected movement is higher, you're going to pay more if you want to, be on that big win side if it does move that far. So usually, you wouldn't have to pay that much for that far out. But with the expected moves being what they are right now, then you do have to actually pay quite a bit more, making out of the money options more expensive when implied volatility is higher, and making deeper in the money options more profitable. Meaning you can receive a lot more money for a further out strike, but of course that's balanced by the fact that the market, can move more. And let's see what else we got. I'm trying to go in. Okay, so what do you do? Either you collect premium on big swings and hope it stays there, okay? Which, again, it's a lot higher probability that it will stay there. So we got 15 minutes for it to stay below that price or to collect some premium on it. You can do that. You sell it 20, 30, whatever, grab $10. The price moves slower. This is another thing that's important. The price will change slower when implied volatility is higher. So I'm trying to give you some of these lessons during this recent week. So out of the money options are more expensive, okay? Meaning you got to pay more for a bigger move. In the money options, pay more. So, you got to go in and you have to actually take that into account. But the biggest thing is people go in and they're like, I'm going to collect premium. And they don't understand that the price is going to move really slow because if IV drops, then you're gonna rake it in on the in the monies and you're going to pay on the out of the monies. But as time passes, you're not going to see as dramatic maybe what you're used to seeing whenever you do contracts that are in the money. Okay, so I am actually more in favor of trading spreads with defined risk than I am in binaries a lot of times in most conditions anyway, but specifically during these conditions. So what I'll do is let's go over here and let's look up some spreads. We'll pull up US Tech. And put this on over here. Okay. So on US Tech, we got a lot of premium on these spreads. There's $200 in premium. That's huge. So, we got 39.80 to 40.60, and you got $200, literally, in premium being quoted right now. What does that mean? Okay? It basically means you're able to buy $20, $200 below the market. The market's at 40.54, you're able to buy at 40.35. So if we look at markets at 40.50 or 40.57, 40, we'll just say 37 to make it easy. So that's 20 points. That's $200 in premium. You're buying 20 points lower than the market. How wide? So if I want to do a premium, this is where I'm more likely to, do it. How wide is this? 39.80, minus 40.60. It's an 80-point wide spread. It's a pretty wide spread. Okay. You have to put up $500 to be able to do that one trade. So that's going to make some people nervous. Now you can go up here, and this is actually a little more attractive, right? Look at this, 250 to make 147. So that's probably actually the most ideal spread right there. Would be that specific one. Let's make sure. Let's see, live's quote the same. Okay, shrink that down. All right. So yeah, so you're getting, it's like a 1 to 2 reward to risk ratio, but it's better really overall than this one, a little bit better, and the amount of money you're collecting. It is a little closer though. It's not as far away. So it's only 15 points away versus 20 points away, and you do have the rest of the day. Is 20 points a big deal right now on NASDAQ? That's the next question you're going to have to ask yourself when you're trying to pick out some of these trades. You have to go over. If I look at this and look at the price that I may want to buy at, is that a price I'd really be comfortable with? So we're going to talk about that when we get back. Is it as good as a deal as it looks like? We'll talk about that when we get back. Stay right there. All right, folks. Okay, so we're looking over here at the U.S. tech. It's sort of breaking up right now, and there's different ways to trade it. You can pay for some really expensive binaries, okay? Or you can check out the spreads. Let's see if the spreads might be more, what you're looking for as a trader. And let me see here. Let's keep that chart up there. We go down here, and we can look at these. So we looked at, like if we were buying the 39.80 to 40.60 and got in a little bit earlier there at 40.37 is where it was at. That's literally like buying the market down here at 40.37. Now, obviously, I'd love to be buying below settlement, but it's below a resistance level up here. And so being able to buy down here and it's up here, as time passes, we make money. If implied volatility drops, we make money. If the market rises, we make money. So we got 3 different scenarios where we can be profitable. Okay, and so it's a pretty sweet way to put on trades. But you can see, like, there's this area right here, like the market. This black line is the market, and if it drops down, okay, to this point, this is pretty much where we're break even on the trade. So. You got a big, but basically the market has to drop about 30-something points as of expiration for us to drop. Now, 30 points is not a big deal right now. Okay, the market, it's only like half a deviation at the moment. So, really not a massive, goal that it has to try to overcome to be able to get, to that point. And so, if I see resistance up here, I'll take some profit, I'll tighten up my stop, and, I'll look for the next breakout if I need to. I can also look over here and I can go, well, can I do the other side? We're climbing up. Here is a higher premium trade, if I thought, the market was going to sort of run out of juice eventually. But here I can sell up at 40.82. Really not that high. I think the market hit there in the next, 5 minutes, the way it moves right now. But I can sell basically higher than the market at that 40.73. I can sell at 10 points higher and help hedge off this position a little bit. Again, I'm not a big fan of that one. It's not as far away as I would like. Got a lot more premium on our downside at the moment. But by putting those 2 positions together, I've created, and they don't have to be the same width, but I basically created what's known as a iron condor. Okay? And so basically I can make money so long as it stays within the range. If I put on that second position. If I just leave on one of them, it can go up infinitely, come down, stay flat, be profitable. So, right now we're bouncing off of a half deviation level. We got some institutional zones, forming. It's trying to see if it can break through. Volume, it's just exploding. So it's really hard to read much on volume at the moment. And so just really keeping a tight stop on that. May grab it here in a second if it drops down. But grab $150, whatever. Not doing a massive trade, and see if it can break through or not, though. But I do expect, this is one thing I try to teach traders, is I expect at deviation levels to get some oscillation. Okay, it usually doesn't just bust right through them. Usually it takes a little time. And so it helps me be a little more patient. I don't want to be patient as a trader. It helps me be a little more patient. But, like right here, there's a short and it's bouncing off of it and it comes on down, 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 down. So just trying to keep that patience when going into a deviation can help you out quite a bit too. But, and again, what are deviations based off of? I provide these, free. They're part of the scanner there, and they're based on implied volatility expected. Anyways, I hope you got a couple tidbits that were valuable for you today, news or otherwise. And y'all have a great day. I'm going to be heading out, and I will see y'all next Wednesday right here on the Diagnostic Trading Hour. Thank you. And I'll be on the show here at 3:20.